As you see, this is the topics is recent market dynamics in global economy. Lots of participants know that we are trying to cover the slides in 40-45 minutes. We have approximately 15 slides, and we are trying to explain and cover those slides briefly. Then at the end of the session, during 10 minutes, I'm trying to give the microphone to attendances, and they are asking their questions simultaneously at the end. But if you wonder some topic, you can also write your question in the chat site during the presentation, and I will check those chat site questions and we'll try to explain those as well. Here, as you see, this is Japanese economic snapshot. Please look at the left. This graph. This is component contribution to GDP. GDP means gross domestic product in an economy. What is producing in the overall economy? And the line here in the y-axis showing the percentage change, and the x-axis showing directly the time axis. And this is year-over-year percentage change in the contribution of the GDP of the Japanese economy. And as you see here, the most of the contribution, positive contribution, coming from the net export, because Japanese is an export-oriented country. They are really producing and exporting lots of products to the rest of the world. But however, as you see here, the consumption side, one of the biggest reduction in the contribution, 1%, is the consumption. So you can ask this question: why the consumption is decreasing in the Japanese economy? What's happening there? The basic reason behind the consumption pattern in the Japanese economy is Japan is approximately in a recession or deflation period during 20 years. So from 1990s till now, Japanese economy cannot increase their inflation, consumption, or the demand in their overall economy. So the Japanese Central Bank, Bank of Japan, and the Japanese government, the government authority, trying to increase the inflation, trying to trigger the demand in the overall household and the public investment side. So they put their interest rate to the zero lower bound. So Japanese economy, public and private interest rate is around zero. There is no cost for the borrowing from the market, from the banking sector, or from the government. And during these years, during these 30 years, lots of investors all around the world, if they have eligibility to borrow from the Japanese market, they borrow the money with the zero cost, because Japanese Central Bank, the Bank of Japan, funding the market with zero cost. They are borrowing with zero Japanese yen to cost, and then they invest those money to the other economies and get a positive return, a net profit, because there is no cost for your borrowing. You are borrowing with zero interest rate in the Japanese economy, and you are borrowing those money, bringing to Europe, other Asia Pacific economies, or the United States, and you are putting those money to the financial market, to the deposit banking, or the government bonds. So, as you see here, the private consumption is a minus contribution, and private investment also has a minus contribution. Just government expenditure is trying to trigger the economy, and the net export is the basic reason who is producing the positive GDP growth in Japan economy. And the right-hand side, if you take a look at a brief look on the right-hand side, this is showing the Japanese core inflation and wage growth. As I explained a few minutes ago, the main problem behind the big picture is Japan cannot produce any inflation dynamics in their economy during the last 30, 20 years. They are trying to increase the inflation, but they cannot achieve. They are giving lots of incentives. They are giving lots of public incentives, private incentives, and they are decreasing the interest rate to the zero overall, but they cannot produce any inflation. The inflation dynamics, price changes in Japan economy is around just zero during these 20, 30 years. Please look at this core inflation dynamics. This light blue line showing the core inflation. Here, we are in the global financial market crisis in 2008. And here, we have the COVID-19 crisis period, and inflation is going down. But in any case, if you look at from 2000 to till now, during the 25 years, the inflation is around just zero. It is not increasing. It is just increased periodically, like here, but then going down. Or look at here, inflation is up to 2%, but suddenly decreasing to zero again. So the main problem here in the economy is there is no inflation. And all authorities, market dynamics, is trying to increase the inflation in the economy. But what happened in the previous week in the Japanese economy? What happened? After 30 years, Japan's central bank see that their inflation expectation is increasing. And they suddenly increase their interest rate from 0 to 0.1. Then, after 1 month, they increased again from 0.1 to 0.25. This is not happening in the Japan economy during 30 years. Please keep this in mind. There is no interest rate increase. There is no interest rate hike in the Japanese economy during last 3 decades. It was just small adjustment when it is increased, but there's no longer period that increased the interest rate for the Japanese economy. But now, after 2 consecutive months, the Bank of Japan authority is saying that they see the inflation expectation for the next 12 months is increasing, and they started to increase the interest rate. Please look at this one. Japan monetary policy and currency valuation. This is showing how the Japanese yen and the United States dollar is moving up and down, and what is happening behind the screen as the monetary policy. This one is the K interest rate in the Japanese economy, and this one showing the yield curve expectation in the Japanese economy. Please look at the screen. The black line, please look at the black line. The black line is the Japanese policy rate. This one, this gray line, or maybe in the screen you see it as gray line. It was here, and from 2016 till now, it was just minus. Think that the government, the central bank, funding the market with minus cost. So if you borrow the money, there is no cost for you. It is minus during 5, 7, 10 years. And here, suddenly, after lots of years, the Bank of Japan started to increase the interest rate, policy rate, to the above line. It was a sudden thing. And as you see in this light blue line, this is 10-year Japanese government bond yield. It was decreasing from 2013 till the 2018. Then it was a little bit a small line. Then after 2020, it has started to increase. What does this mean? If your yield curve started to increase, please look at the screen. Let me share you a basic white dash line. Can everybody see the white screen?
Totally white. The screen is just white so far. Okay. All right. Okay.
No. Please don't move your mouse on the screen. Please. Don't move your mouse on the screen. Ladies and gentlemen, please don't move your mouse on the white screen because you are drawing a line.
Ladies and gentlemen, what Professor Dogan is asking us is to momentarily from your mice or the mouse in each system that you are using. If you move the mouse as he is drawing, there is some type of interference that is created, causing additional lines that not from him to show on the screen. So please do not use your mouse. Thank you for your cooperation.
Ladies and gentlemen, this is a yield curve for a government. This is the time, this is the return on the government bond yield. And this line showing that the maturity in your government, 3 months, 1 month, 3 months, 6 months, 1 year, 3 year, 5 year, and 10 year. As you see, the 1 month, let's say 1%, and let's say 3 months is 2%, and let's say 6 months is 1.8, and then let's say 1 year is 2.5, and let's say 3 year is 3%. What this line showing us? In 1 month, if you put your money in government bond, you will get a return in 1 month in 1%. But if you put it 3 months, it will be around, as you see, 2%. But in 6 months, your monthly rate will be 1.8. What does this line showing us? This line showing us this. The investor, household, private side, the investor expecting that in 1 month, from 1 month to 3 months, inflation will increase. So I'm increasing my investment return yield. But after 3 months, during these 3 months, 6 months, the inflation will decrease. So my yield will decrease. But after 6 months, inflation will start to again increase and yield curve increase. So what is the correlation behind? If I put my money in the government bond, and if I expect during next couple of years, if the inflation is increasing, my yield curve should be like this, increasing, upward sloping. But if the inflation like here, decreasing, the yield curve will decrease. Okay? You should keep this in mind that if you are buying a government bond yield, and if you expect that the inflation expectation will increase, my expectation for the government yield will increase as well. Now, let's return our basic dash line. You see again my slides, right, Dr. Walchi?
Yes.
Perfect. What this blue line showing? This is government bond yield for the Japanese economy. And it is expectation return yield here is 0.2. But now the yield curve saying that during this period, the yield will be increased. Why? Because inflation expectation is increasing for the Japanese economy. As the inflation increase, lots of investors want to compensate their loss because of the inflation, and they want to increase their yield in the government. And government borrow from the market with higher cost. Please keep this line in the mind. First, this one, this black line, this one. Look at this, 0.1%. Then suddenly decrease in the Japanese market in 2016 to the minus 0.10. And during 8 years, it was minus for the Japan economy as the policy rate. And then suddenly in the 2024, the K interest rate for the Japanese economy started to increase. Okay, this should be kept in mind. And then please look at this right-hand side dash line. This right-hand side dash line showing that this light blue is the USD Japanese yen. It is here. Okay. And this one is 10-year US Treasury yield minus 10-year Japanese government bond. So the spread between the Japanese and the United States government bonds. So as you see, they are correlated. If the interest rate spread is increasing, the USD Japanese yen is increasing as well. Then, by the way, if the USD Japanese yen is increasing, this means that it is a weaker Japanese yen. USD getting strength. Now, please look at the main pictures and the behind story, what is happening in the Asia and Pacific region. Global growth forecast here. This is directly showing us that the developed markets quarter the real GDP growth. And as you see here, this is year-over-year change, percentage change. The black one is the United States, the light blue is the Eurozone, and the green one is the Japanese economy. And as you see, from January 21 to July 24, during 3 years, always the Japanese economy growing less until here, right? Until the January 2022. And then just the quarterly percentage change in the Japanese economy is better than the Eurozone, but worse than the United States again. But if we look at the expectation, what will happen to next couple of periods in the economies, the forecast for us saying that Japanese economy quarterly growth will converge to zero, but it will be better than again the Eurozone, but the United States is still better. So Japanese economy can create the growth, but still less than the expectation. And here, emerging markets quarter the real GDP growth. This is not this left-hand side is developed markets, but this right-hand side for the emerging markets, GDP growth. And the red line is the China, the dark blue is India, and the purple one is the Brazil. As you see, normally Chinese economic growth was really high until the 21, but then it suddenly decreased and even less than the India and the Brazil. But now, as you see, Brazil GDP growth is less than the China, but the highest one is the India again. What is the problem here? The problem is here is this. China is the world motor machine of the GDP growth. It was during the 1990s till the 2010, during approximately 20 years, Chinese economic growth each year approximately 6-7%. But the China economic growth converged to 5% during the last 10 years. And this is another disaster for the global economy because the manufacturing growth is coming from the Chinese side. If China does not importing the goods and producing the growth, the rest of the world also decrease their growth expectation. Because if China not growing, world economic growth is decreasing as well. It is machine motor of the global GDP growth. And here, this is the buyback. After the sudden decrease of the global financial market in August 2024, just a few days ago, the lots of companies declared their buyback program for their equity valuation. And as you see here, this is technology, S&P 500. This is United States. This is year over year. And these are the sectors for the S&P 500. This is technology, financials, healthcare, consumer discretionary, communication services, industrial, consumer staples, energy, utilities, materials, and real estate. And these are the way. As you see, S&P 500, 1/3 of it is coming from the technology sector. And the rest is, let's look at this 30%, financial, healthcare, and consumer discretionary. And the last 1/3 is coming from the other sectors. And please look at this 2024. And for the second, third, and the fourth quarter, if you put your money, except these minus sectors, what are these? Industrial in the second quarter, or materials in the second quarter, but also the energy in the third quarter. If you put your money in those sectors, you will get lost in the quarterly period in the S&P 500. But in the last quarter, except the utilities, please look at this one. This is the expectation. Except the utilities, you will get a positive return in any sector. Please look at the financial sector. This is approximately 40% increase expectation. Why? Because everybody is expecting the Federal Reserve, Fed, decrease the interest rate in the September meeting. After the September, the interest rate will decrease, and the financial and banking sector will increase their profit hugely. And if you put your money in the financial market, finance sector, it will get a 40% return in the fourth quarter. And this is the kitchen for the production in the world economy. What we mean by the kitchen in the global market? This is Global Purchasing Manager Index, PMI. Purchasing Managers Index. What does this mean? You have a factory, you have lots of orders from the market. Let's say you are producing the car machine products, and you are ordering lots of ingredients, intermediate goods to produce those car machine products. And this Purchasing Manager Index collecting those orders from the market survey and showing that what is happening in the production side of the economy, what is happening in the manufacturing of the world economy. And as you see, there is two sudden crash: global financial crisis of 2008 and COVID-19 crisis 3 years ago. These are sudden crash because no production in the world economies. And as you see, the manufacturing, the black line, sharply decrease, especially during the crisis period. But the services sector is a little bit better, and it is also recovering higher than the Purchasing Manager Index. And if you look at the right-hand side, the global manufacturing PMI breakdown slide, this is global side. This is developed market, emerging market, US. There are two sources of US PMI. This is market and ISM manufacturing surveys. Eurozone, Germany, France, Italy, Spain, UK, and the APAC region, Australia, Japan, and China, and the Korea, and Russia, Brazil, and Mexico. And as you see here, the Eurozone economy was really crashing in the production side. This is the reason and answer why the European Central Bank decreased their interest rate in June. Because with the higher cost, no factory making any production in the economy, and European Central Bank decreased their interest rate to trigger the growth and the production in the Eurozone. But India, it is replacing the Chinese economy to become the world economic production center. As you see, it is always green. There is no crash, no down, and no cut in the Purchasing Manager Index of the India market. And here, this one is our global inflation. What is happening in global market inflation? And as you see, headline consumer prices. This is consumer price index, year-over-year change in the global inflation accumulation. And here, please look at the developed market, United States, United Kingdom, Eurozone, Japan, and Australia. And this is emerging market, China, India, Korea, Taiwan, Indonesia, Malaysia, and Thailand. And other emerging markets, this is Brazil, Turkey, Mexico, and South Africa. As you see here, please look at this one. If you are in the red line, it is above the trend. And if you are in the below line, this is blue line, this is below the trend. So please look at what is happening in May inflation rate. This is Turkey, my country. It is 75, huge, like the Venezuela and Argentina. These are the three countries in the world which has the highest inflation in the economies. But as you see here, Brazil, below the trend. Or look at the China, below the trend. Or look at the United Kingdom, below the trend. But what is happening in Japan? Japan inflation is above the trend. What does this mean? This is the answer why the Japanese central bank, the Bank of Japan, increased their interest rate, because we should understand the dynamics, the relationship between the interest rate and inflation. If you see, as the central bank, an increase in the inflation, you are increasing the interest rate to decrease the demand and inflation. So, as you see, the Japanese inflation is above the trend. So, what should the Japanese bank do? They will increase the interest rate to decrease the inflation. And they suddenly increase from 0.10 to 0.25. But why this triggered the sudden crash in the world financial market? Because lots of investors borrow the money in the Japanese market with zero cost. Then, when the new maturity date, replacement date of those borrowing come, the new cost will be not the zero. The new cost will be 0.25. Cost will be increased for the investor to the rest of the world if they are borrowing in the Japanese yen. So lots of people and investors started to close their position in financial market because there will be no cheap money again in the Japanese market. So the sell-off circle stopped. Risk of mode start in the world economies. And the Nikkei index suddenly crashed to 20% in one day on Monday. Then it started to compensate those losses. But one day 20% crash does not see during the 40 years in the Japanese economy after the 1987. So when the Japanese market started to sell off more, then this will widespread to the United States market economies, European economies, and during the one day, huge sell-off in financial market, approximately $20 trillion sell-off in the position in the financial market. And how these shocks and how this crash can be smooth and slowed down. We should take a look at the global inflation forecast to understand these pictures better. This one is the developed market headline, consumer price inflation. This is the developed market, consumer price inflation. On the left-hand side, you see the United States, Eurozone, and Japanese economy. The black one is again, the gray one is again the United States. The blue line is the Eurozone, and the green line is Japanese economy. And these are showing the inflation forecast. What this green line showing? It is saying that Japanese inflation expectation even will be higher than the United States and the Eurozone. Normally, during 20, 30 years, there was no inflation pressure in the Japanese economy. But now, yes, there is. The Japanese economy is creating. Look at here. Japanese inflation is just zero. But now it is increasing, and it is also a stubborn inflation. It is not decreasing. It is a smooth line in the upside. So the only solution for the Bank of Japan is increasing the interest rate, cost of borrowing, then the sell-off mode in the world economy. And here, now, not the developed market economies, but emerging market headline consumer price inflation we have. The red line is China, the blue line is the India, and the purple one is Brazil again. China inflation is also increasing, but even less than 2% until the end of 2024. But the Brazil and the India is above the 4%, but Brazil inflation is decreasing to the 4% of the reference line. And this one, the G4 central bank policy rate and market expectation. You know, we have G4, G3, G7 in the world economies. And the G4 policy rate, as you see here, this is really, really important for us. The black one is the United States. The purple one is the United Kingdom. Light blue one is Eurozone. And the green one is Japan. Please look at this one here. Eurozone, United States, and the United Kingdom increase their interest rate. But the green line is still same until the June meeting of the Bank of Japan. Here, as you see, after years and years, Bank of Japan started to increase their interest rate and trigger the fire in the world economies to bring the sell-off mode, to increase the Japanese yen valuation, and to start to decrease in the Nikkei, S&P 500, and Dow Jones index. And what is market expectation? Please look at the difference between the scheme. Those three economies, Eurozone, United States, and United Kingdom, decreasing their interest rate. But what is happening in Japan? It is directly increasing. Across cycle of the world developed market. Normally, the developed market economy central bank decreasing their interest rate, but the Japanese economy started to increase their interest rate, and it is still smooth. There is no expectation for rate cut for the Japanese economy as well. There will be no expectation to decrease the interest rate in the Japanese economy. By the way, this line is also really, really important for us. What this gray dash line here in this picture, please look at this gray dash line, this one. Normally, the United States, the black line is this one. Normally here, as you see, it is decreasing. But 6 months ago, the expectation for the United States like this. What does this mean? Market is expecting from the Federal Reserve decrease their interest rate earlier than today. But the reality showing that United States interest rate is still high, but it will decrease if the market expectation holds until the end of 2025, gradually from 5.5 to the 4% at the end of 2025. And as we say in the beginning of the presentation, we try to cover the Japanese economy because they triggered the financial market turbulence in the August 2024. But why this turbulence cannot be compensated easily? Because United States monetary policy is here. This one is the federal fund rate market expectation. This is United States federal fund interest rate. And as you see here, after the COVID crisis, the interest rate put down, interest rate cut period start. As the inflation increased, the interest rate started to increase to the 5.5. But what the market is expecting for the next 2 years, this next 2 years is this. Please look at this blue dash line, purple dash line, and the green point. This blue dash line showing Federal Open Market Committee expectation for the interest rate. But the purple line showing the market expectation. What you see here, until the end of 2025, market expectation and the Federal Open Market Committee estimate is almost same. They are saying the interest rate will decrease until the 4%. Please look at here. This is 4%. Until here, Federal Open Market Committee and the market expectation is almost same. But after that, FOMC, the Federal Open Market Committee, saying that we decrease the interest rate 1% more from 4 to 3 during the 1 year in 2026, but market saying that no, you will decrease less than that because there will be inflation in the market because you decrease the interest rate during the 2025. So you will be slowed down in the economy, then the interest rate will decrease slower than that. Now, this one is the last presentation for the Japanese economy performance drivers in economic indicators. And please look at this picture. Correlation between currency and equity movement. The rolling 1 year correlation between movements in the United States Japanese yen currency parity and the MSCI Japanese index. Please look at this line. Currency and equity performance move together if this is up. But if this is down, currency and equity performance in opposite direction. It should not be in the economy. If there is something like this, if this is going down, there's a problem in market indicators. If this is going up, everything is going well. So please look at this line. In the Japanese economy, except some periodical cycle, the correlation between currency and equity is breakdown. It is not normally moving up and down at the same time. The correlation breakdown in the currency and Japanese equity market. I want to